everyone. Good morning and welcome to this exclusive webinar on Market Outlook and ICICI Direct tools and platforms. So I'm delighted to join by Pankaj. Pankaj heads the research for ICICI Securities, and my name is Saurav Sultania, and I look at ICICI Direct products and platforms. We're going to talk about, as the session speaks about, which is Market Outlook. So we're going to talk about that, and who better than Pankaj? But Pankaj, I mean, it's been a tale of, as they say, two cities, right? One, so much of news in the markets. Every 15 days now, there is something, which is, which comes like the world will end, right? I mean, from Israel, Iran to tariffs. I mean, tariffs are still not over. We're hearing something big on Monday. I mean, so many, so much which happens. Markets then have movements which shakes investors. I think that's I must say is a problem which we've seen 22,000 levels. So and at the same time, true wealth creation has happened, right? For the patient investors, for the long-term investors, somebody who would have bought not at this dip but any dip over the last many years, they've been very, very well rewarded in the markets. So as I said, tale of two cities. How do investors kind of build portfolios for long term? What are the things that they should watch out for? Which are those themes? Because one thing of all the all the negative or all the hype surrounding equity is the long term. A little longer term vision, right? So with that, Pankaj, where do you see markets? There is a lot of good things happening in India. But where are the opportunities? Where are the risks? I think all of us are very eager to listen to that. So that that since we are more aware about how things will be, we can kind of invest better. So Pankaj, what do you and your thoughts here?
Thank you, Saurav. Very good morning to all. It's my pleasure to be interacting with you all today. So I'll share a small presentation where I'm going to overall talk about most of the things which Saurav wants. So before I come to the overall things which are sort of going into market, so last 1 year, what we have done in terms of price performance is about 5% kind of a overall price performance. Compared to that, a lot of other markets like US S&P made a new high yesterday, whereas China is already sort of doing well. There are some emerging markets which are sort of doing well. And even from a 1 month perspective, also our performance is sort of modest, I would say. And this is more to do with the fact that there are two things which are troubling investors or creating anxiety at this point in time. One, obviously, is the tariff-related developments. Now, if I sort of go by the recent announcement, what is being coming out is that there could be a blanket tariff of 15 to 20% on all countries. So greater than 10% standard is what is being talked about. And according to Trump, since US markets is making a new high, so tariff is sort of well received by the markets. And while in the last 1 week, if you sort of notice, volatility is down in US, gold has started to sort of correct, and stocks have gone up, and they've made a new high yesterday only. So in a way, markets are getting desensitized to tariff, and largely it is coming out that they don't take the tariff rates for granted, because the deadlines after deadlines are sort of being pushed. But having said that, we still feel that overall India will sort of stand out. One, because I think there is a global scarcity of secular growth, and India is one of the few markets which can offer that. Now, coming to sectoral performances, so banking is something where we have seen the maximum amount of changes coming from the RBI. And that has started to sort of do well. And it's very heartening also because banking or BFSI is one of the biggest sectors, not only from the market movement perspective, especially Nifty, and also from the earnings perspective as well. and that has started to sort of do well. On top of it, pharma is also sort of doing well, and it is less likely that the Indian pharma will be impacted compared to the kind of threat of 200% tariff what is being talked about. So markets overall have done modest 4.7% kind of a growth, and overall earning growth also has been on the similar line. So market is trending in line with the overall earnings number. And I'll come to earnings also, but before that, this is my favorite slide. So every year since 2007, whether it is large cap, mid cap, small cap, all the indices have the tendency to correct. So Nifty, for example, has the tendency to correct 10 to 15 odd percent. Mid cap slightly more risky, so it corrects in the range of say 15 to 25%. And a small cap, obviously being more risky than large cap and mid cap, usually tends to correct 20 to 35 odd percent. What you see in terms of bigger bars is the period when extraordinary things have happened. So 2008, where we had a financial crisis, you don't really get those kind of events on an annual basis. Similarly, 2020 was a COVID year, so that impacted the market performance. So from that perspective, if you sort of exclude that every year, like I said, the ranges which I mentioned, markets has the sort of a tendency to correct multiple times from the highs. Now, one way to sort of approach this is to stay away from the markets because markets are volatile. But our sense is that in correction, the opportunity to make money is quite high. And market, like I'm sort of displaying, has the tendency to correct every year. So this is how what one can use the corrections to the maximum. Otherwise, overall, in a normal trending up market, which is what Indian markets have been, the normal money-making opportunities are visible, and we try to sort of capture both the legs of it. Now, for any market to perform, not only in India, but even for India, there are some macro variables which are extremely important. So for India, overall, in terms of macro variables, inflation and crude oil are the biggest macro variables. And if you sort of notice on the PPT, what we are sort of displaying is that there was a period between say 2006 to 2013. The average inflation used to be 9%, and that came down to about 5% between 2004 to 24. What you are experiencing is under 3% kind of inflation. And so macroeconomic variable from an inflation perspective is pretty good. If you sort of notice, the overall monsoon spread is also quite good, except for Bihar. Most of the districts have seen normal or above normal rainfall. The other is on the crude oil front. Now, crude oil, gone are the days when coal and crude oil were the only energy sources. Now you have a lot of renewable energy sources which have come up. And as a result, crude has been softer, and it's a sort of a big positive for us. And overall, crude remaining below $70 is a macro positive for us. And a culmination of both these positives is leading to lower interest rates. We have seen RBI sort of cutting rates, and eventually the impact is also visible even for the borrowers also, because the rates have been cut for categories like, say, for example, home loan. On the Forex side, we are already doing very well. Forex reserves are at a lifetime high. So from that perspective, most of the macros are good. So for any market to perform, you need 3-4 things. You need corporate earnings to be good. You need macroeconomic variables, which I just spoke about. Valuation is another factor. And then the liquidity is another fourth factor, which is very important for markets to do well. And I'll come to some of them later. Now, coming to earnings, FY25 as a year was a challenging year from an earning growth perspective. You had about 8 state elections. On top of it, we had Lok Sabha elections, and somewhere down the line, because of all this, the overall government spending happened in a back-ended manner, and that sort of impacted the overall corporate earnings. And corporate earnings in FY25, the growth was 2 odd percent. But this year, FY26 onwards, we feel that FY25, what happened was a one-off. And overall sense is that earnings will start to recover. Just to give a case in point, say, for example, for an index like Nifty. Now, BFSI is the biggest sector, contributing nearly about 37% kind of a weightage. And if I look at the Nifty EPS of, say, 1,225, which is what we are estimating for FY27, 43% of those earnings are going to come from BFSI. So BFSI is extremely important. Last year, banks were under pressure. Their margins were under pressure to the tune of about 12, 13 odd bips. Even for next 1 or 2 quarters, this quarter and the next quarter, the margins are expected to be under pressure, but not to that extent, because we have already seen central bank or RBI cutting CRR rates by 100 bips. And that will lead to a lesser decline in Nifty or BFSI earnings. And in the second half, banks are expected to recoup the margin loss, and which is why our sense is that from FY25 onwards, for next 2 years, the overall corporate earnings are going to grow at 12%. And from a valuation perspective, what our sense is that historically markets have traded at 16 to 20 kind of a multiple. But we have given a higher multiple of 22 times, and I'll explain reasons for the same. If you all sort of notice what has happened in the last inclusions and exclusions, we have 2 stocks, BPCL with a market cap of 1.3 lakh crore. Similarly, Britannia, similar market cap, 0.5% weightage of both. So both these stocks went out of the Nifty, and their cumulative profit on a FY27 basis was 20,000 odd crores. So these stocks were commanding an overall multiple of about 14 times. Whereas what you have got now in the Nifty is, say, Eternal, which is Zomato, 1.5% kind of a weightage. Market cap is 2.4 lakh crores. You have Geo Financial, where the market cap is also in excess of 2 lakh crore. Now, these stocks, both these stocks, the profit is about 4,500, and both these stocks on a combined basis are getting a P multiple of somewhere about 96 times on FY27 basis. So what you are getting into the index is expensive stocks, and what is moving out of the index is cheaper stocks. And which is why we feel that the overall Nifty EPS will keep getting higher. Just a case in point also is a stock like, say, for example, Trent. Now, Trent has seen a decent amount of correction because it used to grow at 39%, then about 27, 28 odd percent a quarter before. Now they are talking of about 20% kind of a growth. 20% growth is still quite fine. But this stock even now is trading somewhere about 66 times on a forward basis. So if your more expensive stocks come in, there is a tendency for Nifty EPS to sort of P multiple to sort of go up. And which is why I feel that the Nifty target of 27,000 is not much. So we are expecting new highs in the market across caps, be it large caps, mid caps, and small caps towards the end of this year, because earnings will start to recover in the second half, especially for banks and other sectors also. And I think overall sense is that even the mid caps and small caps will sort of do very well. So worst is behind us in terms of earnings, and overall sense is that you'll see a double-digit earnings, and proportionately that will get captured in the Nifty targets or Nifty levels as well. Now, if I come to the liquidity aspect, liquidity again can be broken down into 2 parts. We have domestic liquidity and we have the FPI inflows. Now, on the domestic liquidity front, you would all have noticed that we are getting inflows, net inflows in excess of 20,000 odd crores on a monthly basis. SIP number has gone up to about 27,000 odd. Most of your core categories, whether it is large cap, mid cap, or small caps, or flexi cap, most of these categories are seeing better inflows compared to what they've been getting earlier. So domestic inflows are definitely not a problem. There was one concern that in case the market corrects very substantially, the will dry up, but we haven't seen those cases. What gets highlighted again is the SIP stoppage ratio. And our sense is that people who have come to the market in the last 2-3 years, they are finding it difficult to sort of digest the volatility, and that is why some of the SIP cancellations are there, and which is what is getting captured in the data. But people who have been in the market for a long period of time, I think they clearly realize that Indian market is one of the best markets in terms of secular growth. And so domestic liquidity is absolutely not a challenge. I think even if you look at the positioning of the mutual funds, which are the biggest in the segment, they are sitting on a dry powder of about 1.7 lakh crores. So just to give an example, Balance Advantage Fund, typically they hold overall So the current cash holding or money which is put into arbitrage or debt is about 55%. And in good times or decent times, this holding goes to about 40%. So typically 60% goes towards equity. So I think since markets are expected to recover, and which is why we feel that the domestic, all these domestic liquidity which is lying with the mutual funds will sort of get deployed. So domestic liquidity does not look like a challenge to us, and the kind of inflows what we are getting in terms of SIPs, we are already crossing our domestic inflows of nearly 3 lakh crores. Now, coming to the FPI flows, see, the challenge always has been that the FPIs have been very volatile. And we have seen since October last year, that is when the majority of the selling by the FPIs sort of started. And from that day on, from that month onwards to now, they've sold about 1.78 lakh crores. And just to sort of highlight, when we sort of break this picture into sort of sectors, a big sector like BFSI or financial services, I'm just giving a universe of NSE 100 because this is the set of the stocks typically FPIs operate. They don't operate much in mid caps and small caps. So top 100 stocks, BFSI is again 34% in terms of weightage. But when you sort of look at the selling of the entire 1.78 lakh crore selling, the selling in BFSI is only about 6,800 odd crores. So they are no longer sellers in a big segment like BFSI. In fact, if you sort of notice from April, May, June, the inflows are positive there. What is getting or attracting maximum selling is the oil and gas pack, power to some extent, and FMCG because of the growth concerns, and also a bit on auto. So the overall sense is that the FPIs, which were very negative at the from October onwards, have started to sort of turn positive in the last 3 months. And in fact, June was, May or June was the good amount of inflows we have seen to the tune of about 19,000 to about, say, 15,000 odd crores. So FPIs are no longer selling the markets. And our sense is that with the way Trump is behaving, it is the setup is that it's a negative dollar or dollar is not going to perform, and which is why I see weakness in dollar, which means that the money is going to come to other asset classes. It could be gold, it could be bonds, emerging market bonds, it could be emerging market equities, including India. So from that perspective, the setup from a FPI perspective is also turning favorable for us to sort of do very well. Now, if things are getting better domestically, what I want to sort of highlight is for the next 5-10 years, the sectors which we feel are more relevant is one, obviously, on top of the charts is capex beneficiaries. I think it is very clear that the current government template of 3% spending of GDP on infrastructure is going to stay. And so from that perspective, the entire value chain of capital goods, infrastructure, cement, steel, all of them will benefit. We are already seeing sectors like power and auto witnessing transition. So for example, power, solar energy and wind energy is taking center stage. And in autos also, we have started to see 5 to 7% kind of a penetration of electric vehicles in the auto as a chain. So from that perspective, these two sectors are witnessing the transition benefits. And the BFSI is a structural measure beneficiary because post IBC, what we are clearly saying is that 2018 was when the big NPA cycle happened, or when the big NPA recognition happened. It's been 7 years. Most of the corporate profile is good. So gone are the days when every 5, 7 or 8 odd years we used to have an NPA cycle. I think that is a thing of a past. So BFSI from a structural measure perspective looks good because post IBC, what is very clear is that the promoters don't want to lose control of their company. And last leg is on the consumption side. So there are select pockets of consumption which are doing well. Real estate, again, the premium leg of the real estate is doing very well. Hospitals, hotels are another ones which are sort of doing well. And auto, again, very selectively, things are doing very well in the auto in select pockets. So premiumization is again being witnessed in select categories. Now coming to the capex part, so FY25, if you all sort of notice, the the overall capex in the economy is about 29 lakh crores in FY25. 11 lakh crore is what is done by the listed companies now. So they've overtaken the center capex of 10.5 lakh crores, and the state capex is somewhere about 7.7. And this number is going to get bigger only because most of the corporates in India are carrying a very healthy balance sheet. So from that perspective, once this tariff-related anxiety sort of settles down, at least I would want to believe that the private sector will take sort of center stage. And just to sort of highlight is that the potential of private sector capex, one needs to sort of go back to a year like say 2010, 2011. So that point of time, the central government capex was about 1.1 lakh crore, and the private sector capex used to be about nearly 4 to 5 times of the central government capex. Now, when you sort of notice FY25 number, both are largely even 10.5 and 11 lakh crores. So private sector holds a good amount of capacity to do capex. And our sense is that as and when these tariff-related uncertainties sort of start settling down, the private sector capex will sort of do very well. Where the capex is already happening is utilities. Clearly, that is taking the maximum share, about 17%. Then you have energy. So again, energy is about 14%. You have big corporates like Reliance, which are doing. Then you have auto, metals, and industrials, which are doing about 8 to 9%. So these are the key sectors where majority of the capex is concentrated, 71% to be precise. And our sense is that going forward, the listed corporate capex is going to be a lot more higher than what we have seen, and which is why we feel that the capex as a cycle is going to remain in vogue for a good period of time. Now, like I said, power is one sector which is seeing a significant structural change. One, I think power consumption is expected to grow at 7% and in that, what we're clearly expecting is the renewable energy space is expected to grow at 21%. And thermal is required largely because solar is not available all the time. So which is why you need a backup power, and which is why thermal is also expected to grow at 6%. And this is also required from the perspective that a lot of heavy polluting sectors like, for example, steel, cement, they are expected to sort of generate or take more of green power to sort of produce steel. Europe is already going to implement a carbon tax because of this, so which is why a lot of Indian corporates also, if they want to export, will have to sort of tweak their power source. So power is going to be a central theme. And when generation is already there, the distribution leg also needs to sort of witness good amount of change. And the government has highlighted overall capex of 9.5 lakh crores the next 5 years on the transmission and distribution side. So overall capex in power itself is expected to be about 30 lakh crore going forward, which would be a mix of thermal, renewables, and private sector. And just to highlight, in terms of solar addition, so there was a period of time. So, for example, say between 17 till 21, the average addition used to be about 7 gigawatts. And last 3 years, FY22 to 24, what we are clearly seeing is that those numbers have literally doubled to nearly 12 to 13 gigawatt kind of annual capacity addition. And FY25, we are already doing about 24 gigawatt, or we have already done 24 gigawatt kind of a capacity addition. And bulk of the addition is happening, especially on the solar side. So I think overall, India is doing very well on the renewable energy side, and this is one of the few important sectors where the maximum capex is being undertaken. Now, defense is always in the limelight, and I am just going to highlight the structural transformation which is sort of going in the defense as well. Now, in defense, just to sort of put some number, FY13 to 22, we have seen 8.5 lakh crore of acceptance of necessity. So what happens that once you do acceptance of necessity, that is when the ordering tendering also happens 1 or 2 years down the line. So acceptance of necessity between 2013 and 22 was 8.5 lakh crore. But last 3 years, FY23 till now, the acceptance of necessity has been granted to 10.5 lakh worth of projects. You see, what we have done in the last 10 years is what we are doing in the previous 3 years. And so defense is one of the few sectors which can easily deliver high-teen kind of a growth. And if you sort of notice, most of your defense stocks, they're sitting on pretty good order inflows, and this order inflow is expected to sort of go up, and which is why government is looking to sort of tap even the private sector in terms of helping it with the overall production objectives. So defense is one sector which should do very well. And now I'm not talking from a stock perspective, because this is one sector which has done very well from a price performance perspective. Most of your defense stocks are trading at about 48 times on FY27 basis. So valuations are definitely rich. But since the structural outlook is very positive, so any major weakness in defense should be used as a buying opportunity, and which is why I feel that this segment or this sector is going to do a lot more better going forward. Obviously, the price performance has already been captured. Our sense is that it might witness some bit of a time and price correction, and that is where you all can look at having exposure towards. Now, cement is another sector which is witnessing a change. So FY25, we had elections, so demand was muted. Demand grew by 4%. And as a result, the cement prices were weak. Last year was one of the worst years for cement. But things are looking up quite good for cement as a pack, largely because now overall demand is expected to grow at 7%, whereas the supply is going to grow at 6%. So which means that the demand-supply equation is turning favorable, and that will lead to better capacity utilization rates. And also, this is going to support the cement prices as well. And cement, again, is a very basic building block, which is why I feel that the sector will do well. And also, most of the bigger players have done both organic as well as inorganic expansion. And the top 5 players now control nearly 60% of the capacity at this point in time, which would also mean that the price discipline is going to be a lot more better than what we have historically seen. Now, BFSI is an extremely important sector. But of late, what you have sort of noticed is that the credit growth in the system has sort of cooled off. So credit growth in FY25 was down to about 10%. So what is growing now, say, for example, within corporates, again, is the mid-corporate. So MSME continues to be a big focus for most of the banks. Large caps are already sitting on decent amount of money. So they are not really requiring too much of a bank loan to sort of do that. And a small cap or SMEs are sort of also doing okay. So one of the reasons why this credit growth has sort of come down is, again, one, we are experiencing lower inflation. The other one is a lot of measures were announced by RBI. So, for example, if you sort of notice of the overall credit of about 181 lakh crores, 50,000 or 50 lakh crore is coming from the services. A good chunk of that is the bank loan to NBFCs. Since last year, RBI had increased rates on bank loan to NBFCs. Bank had actually stopped lending. So, which is why the pie for NBFC credit FY24 to 25 hasn't grown. And on top of it, in some of the sector segments, like say unsecured loans, especially credit cards, personal loans, RBI had sort of advised banks to sort of go slow. So that a combination of all these had a fair share of impact. RBI has started to unwind a lot of these measures. The weights of bank lending to NBFCs have done away with, so those weightages have been brought back. So now the situation is very conducive for credit growth to happen, and which is why we would want to believe that on the credit growth front, there is a recovery ahead. On the consumption side, broadly in India, you have about 31 crore households. You have about 5% of those households, which is 1.5 odd crores, who have got an income of nearly 30 lakh plus. Now, this number is going to sort of literally double in the next 5 years to about, so households will become nearly 3.5 crores, and So which is why you are already seeing, which I said, some of the premium categories are already seeing a better growth. Same is the case with the upper mid segment, where earnings is in the range of 5 to 30 lakh. There also you have about 10 crore households, and that number also you will see a significant improvement to about 16.5. So what you're clearly seeing is that the overall there is a shift in income or at the higher level also, and even at the bottom of the pyramid, people or households where the income is quite less, that pie is also sort of shrinking, and which is why I feel that overall some of the consumption categories, which just I highlighted some time back, should do very well. And real estate obviously is one of them. Now in real estate also, if I have to sort of look at the kind of cycle it is happening. So there was a period in time, say for example, CY 14 to say something like CY 22. That was a point in time when the real estate prices did not move up, and from that onwards, we have seen a 60% kind of appreciation in the real estate prices. And I'm just breaking this into three parts. So calendar year 2015 to say 17, there was a point in time when the supply was pretty good at about 8 lakh, and you had the industry, so you had a lot of local players used to sort of dominate, and the demand was end user driven. And so again, the corporate entry wasn't there. And then after that, in between, the COVID also happened. The inventory had gone up to about 55 months, which was significantly higher. The demand was not so there. And again, this was the end user market driven. Now, what we clearly see is now the supply has sort of picked up. And now, gone are the days when the real estate used to be a localized market, and which is why you see that big companies like DLF coming to Mumbai again. You have a lot of other South-based players like, say, Brigade, Shobha, or all of them moving into different parts of the town. Even something like Godrej Properties is there in multiple cities. So this is one industry which is getting organized. And our sense is that real estate as a cycle will keep doing better for the next few years because one, the corporates which have come into, they've got better balance sheets. There is no major debt issue languishing or being with most of the players. So you don't have that kind of, and even buyers are also looking at properties which can be delivered on time within their timelines. And so industry is getting into a discipline mode, and our sense is that overall top players now contribute nearly 20% of the market. So even if the market does not grow, the real estate listed players are expected to do well. And like I said, more premium upgradation is also sort of being seen because of the shift in the income, which I just spoke about. So hospital is another segment which is always there in the news in terms of, so for example, you have company like Apollo, you have Max Healthcare, and now we have unlisted player like Manipal, which is vying for the top number one spot. And this sector, both on the listed unlisted side, you see a lot of news flows. Structurally, this is another sector which is going to do very well. Overall growth rate is expected to be 18%. And this will become better or more durable once we see further penetration of health insurance, and also further penetration of the radiology market, because the more tests gets undertaken, it is quite likely that early detection of diseases will happen, and that will lead to timely hospitalizations and better services from hospitals, and also better revenues for them as well. And also they are sort of getting a lot more digitized. So from that perspective, hospital is another segment which we feel is very structural in nature from a consumption perspective. So last one is, see, hotels. Now, in terms of hotels, India has got about only 270 keys per million people compared to look at something like US, which has got 16,000. You look at any country, we are one of the lowest. And what we are clearly seeing is that if you notice in the PPT, on the occupancy side, occupancies post-COVID has touched 267 odd percent. This is going to get better only. The daily rates have been perking up, or the revenue RevPAR is also sort of inching up for most of the players. And I think also on the tourism front, so this was a very trending up number. every year we used to have an incremental improvement in the foreign tourist arrivals, which got disrupted during COVID. But now our sense is that this is going to sort of get normalized. So this is another sector where the demand supply mismatch is still there, and which is why if you all have taken holidays, you would have noticed there is a clear appreciation in terms of the kind of room rates which are being charged, and this is more because of the demand supply mismatch this sector is experiencing. Overall, this is another sector which would be doing high teen kind of a growth and good profitability going forward. Now, I spoke about sectors and some of the stocks, again, to sort of play some of these themes. This is not a very exhaustive list. This is just a list, indicative list at this point in time. And overall, this list is going to be even more better. So on the lending side, so it's all about the big lenders, HDFC Bank. Last 1 year, they haven't really grown. They are sort of getting in shape. So HDFC Bank, Kotak Mahindra Bank last numbers were quite good because now they have started acquiring customer after the RBI ban. So that has started to do well. And Axis and Bajaj Finance and Federal Bank within the BFSI space looks very good. I spoke about capex cycle being very good for the next 5-7 years. We like the entire value chain. You have companies like L&T, ABB, Siemens Energy. Siemens Energy is a good play on the HVDC value chain. I spoke about 9.5 lakh crore kind of a capex on the transmission and distribution side. So this company should benefit. Similarly, bearing companies are basic product utilized in a lot of places, right from wind turbines to railways, a lot of places. So Timken and SKF is something we would prefer. KEC and KEC International is on the power transmission and distribution side, and water management company called Vatek looks good. On the cement side, most of the players are trading at reasonable valuations. So big ones like Ultratech, Ambuja, or mid cap like something like JK Lakshmi Cement looks good. I'm very selective on the consumption side. So you'll have hotel companies like Indian Hotels, ITC Hotels, Lemon Tree. In FMCG, again, we are very selective because one, the valuations are quite high. It is very unlikely that the FMCG companies typically will outperform the Nifty earnings of 12%, what we are saying. But some are still expected to do well, the likes of Tata Consumer and Marico. So power, again, overall, this sector should do well. Last 1.5 months, we had early monsoon, so a lot of these stocks haven't done from a price performance perspective. But our sense is that things will start getting better. And also, there is a good possibility in the monsoon session, government might come up with amendment to the nuclear liability bill. So that might sort of bring further interest in the sector. So companies like NTPC, Tata Power, KEC International, HBL Electric is a play on smart meters. In auto, again, very selective. M&M is doing very well, both in the tractor front and also on the SUV front. Whereas Maruti is struggling because no one wants to sort of buy sedans these days. Everyone wants SUVs. So M&M is clearly doing well, and then PCBL chemicals, which is what they make and goes into a tire, is what we prefer. Hospital space, Apollo Hospitals, Narayana has done well, but any kind of a correction is a good buying opportunity. And HCG is another KKR company, and KKR had done very well in a big hospital like, say, Max Healthcare. Our sense is that they have taken over the promoter stakes of this company, also is expected to do very well. Real estate, NCR market continues to sort of do well. You have Camellias from DLF attracting good amount of interest from HNIs. So that looks good. Aditya Birla Real Estate, again, from a good group, and Max States, which is considered overall of NCR, is looking good. Metal, I'm being selective because we still don't know how this tariff policy will pan out. We keep reading punitive tariff being put. So selectively positive on a company like Tata Steel, because now their 80% of the EBITDA is coming domestically. They have increased their capacity here. So you'll see volume growth plus better pricing. So Tata Steel accordingly. Now, to sort of sum up, in the next 5-7 years, I think India is the only market where secular growth looks quite possible. And within that, equity markets in India are probably the only asset class which can deliver durable double-digit kind of a return. So overall sense is that 7 to 8% kind of a GDP growth rate, a GDP size of $7 trillion, and 12 to 15% kind of a CAGR in equities is very much possible. So I think this is something, an opportunity which one should not miss over the next 5 to 7 years. That's all I have to say. Thank you so much.
Thanks a lot, Pankaj. Thank you so much. Pretty exhaustive. So not many questions left. Just one thing on gold. I mean, any view on gold? I think that's an asset which has definitely seen a lot of interest. I mean, it's for years now, not just now. But any views? One on the short term, and then a little bit on the medium term on gold as an asset to hold.
So, Saurav, yes, gold is actually competing with equities in terms of price performance last 10, 15 years. Because just to sort of break the gold performance, say between 2002 to 2012, gold did 6x kind of a return. So from a 5,000 rupees per 10 gram, it went to about 30,000 per 10 gram. And then again, if you look at from 2012 to 18 onwards, next six years, absolutely no return. That point of time, the global gold prices had corrected by about 45%. But since the rupee sort of depreciated in between, so which is why domestically, we haven't seen that kind of a decline in the gold prices. And again, 2019-20 onwards, we have seen nearly 3x kind of a gold from nearly 30,000 rupees per 10 gram to about a lakh. And this is happening now again because of the fact that people are not sure about the fiscal deficit US is going to carry or the kind of debt what they're carrying. So there is a lot of anxiety related to global growth. And gold is clearly benefiting from this aspect. I think post Russia, Ukraine also, a lot of these countries started to sort of use their currency as a weapon also. So that has led to a shift in gold. Since the gold has rallied up quite fast, Saurav, so near term, I'm not very positive on gold, and which is why probably some correction is required. And I think peak of the anxiety related to tariff is also sort of settling down. The US market, like I said, is at a lifetime high. Gold is down 1 week despite all this rhetoric in the last 1 week. So near term, there could be some weakness, but structurally, I'm very positive because US is going debt to GDP is very high. Plus, what they are looking to do is that curtail the overall trade deficit. So from that perspective, I think structurally looks good. Any weakness should be used as an opportunity to buy, but don't buy it from a near-term perspective.
Awesome. Right. Thank you, Pankaj. Covers, I think, two very, very critical asset classes, gold and equities, which truly has created wealth for investors. This part of the presentation now we'll move is on the platform. Pankaj spoke so much about which stocks should you invest, how do you build your, investments, and now the next part that we move is how do you perform it on ICICI Direct. So I'm just logging into the ICICI Direct account, and I'm just putting up the screen. And one of the traditional ways typically people log in through the brokerage platforms is through user ID, password, and OTP. On ICICI Direct, I mean, you could also log in through the QR code, right? I mean, so you have to go to your mobile app, and on the mobile app, on the menu section, you will see option to get QR code. So, you don't have to log in with OTP. You don't have to call up or OTP. You just, log in on the account, very, very simply. I'm just opening up few charts, on the screen, for all of us. And, when we look at markets, obviously 3 months, 6 months, you see so much of volatility in stocks. But, if you just, just go back a little, each of these stocks and any of these stocks that you could look at and a little longer period of time, which is, let's say, a year or even 5 years, you will see a different kind of, growth. I mean, the stock has given a dividend. Basically the point is that companies take, years to kind of, build their business. I mean, businesses are not, don't deliver results in 3 to 6 months. So in equities, being patient with investment is a little important thing. which is one thing which I just wanted to kind of talk to. But let me come to now the key things on the platform. And let's say, I mean, any stock you want to analyze. And let me start with Bharti Airtel because that's a stock. At one point of time, people used to say Bharti Airtel with Jio coming in, Bharti will, I mean, have a tough time. The stock is up, nearly 5 times. I mean, it was 300 rupees around 4 5 years back. Today, Bharti is what trading at 1900 rupees. So I'm saying, stocks truly have created wealth for investors. And on the ICICI Direct account, I mean, you could, I mean, and I'm talking about Bharti, a lot of information is known, but you could look and analyze, how, what Pankaj was speaking about, what is the kind of earnings growth the companies are having, so that, there is much more, confidence, conviction that we have on the companies, and then, we hold them. So if you look here, I mean, over the last, few years, few quarters, how the profit for Bharti has moved, right? From around 1800 crores to around 9000 crores of profits. I mean, you can look at their cash profits. You can even look at some of the key highlights of the results. So a lot of information on the stock is, and in fact, the full information on the stock. You can even compare Bharti against, various of its peers, and you have a fair sense of, which stocks, which sectors, would you want to invest, right? I mean, would you want to make into a company which is not growing at all, or there is a lot of debt? I mean, and you can even go and look at the entire PDF, the presentations, which really, I mean, which is important to build conviction. I think the entire problem with, the need of investing is to know more about the companies that we're investing in, so that, we could hold. And one more thing which is there is the deals, I mean, large deals which are happening in the stock, and even insider. I mean, if somebody, is hold, as categorized as a promoter, are selling or buying the stock. So all the information about the company, you could look at on the ICICI Direct, platform. I mean, both on the mobile platform and on the web platform. Such information are available, for all of us to analyze any number of 6,000 stocks that we see, right? So I move to, the other part now on, I mean, let's say, I mean, Bharti Airtel. I mean, if I were to, if you were to think about buying the stock, I mean, we look at a little bit on the price of the stock over the last few weeks and months, and we want to place a trade. So the capability that you get on the platform, so Bharti trading at 1920 rupees, would want to buy the stock at this price, and say that whenever Bharti touches 2100 rupees over the next 15 days, 3 months, 6 months, 1 year, you could place an order along with your main order. So you're buying at 1921 rupees, and you're saying that when Bharti reaches 2100 or 2000 rupees in the next whatever period of time within the next 1 year, our systems will book the profit also. So you could set orders with a target price, when you're placing an order itself, right? And for somebody who's more conservative, you don't want to lose beyond 50 rupees, 60 rupees in a single stock. You can also put a stop loss. So that's an option that you get. But typically, the simple use case is that you buy a stock and you place a target with the stock over the next valid for a year. So as I said, I mean, for any stock that you would want to buy, I mean, all that you need to do is, you need to click on the trigger GTT, which is a trigger order, and, you place your target price for any stock. The other thing, I mean, for investors, I mean, if I'm just taking Bharti, an example, as somebody, somebody's gotten late, and even, if has bought Bharti at 1500 rupees, right? And so or somebody who's bought in the stock at even let's say lower. So one of the problems with investing is that if the stock falls, I lose the profit that I have made, right? So now let's say I bought it at 1100 rupees, the stock is 1900 rupees. I want to at least ensure that till 1700, or let's say what, I mean, a particular price, I will get some profit, right? So let me just, I mean, I want to ensure that I, get at lock at least, 700 rupee profit in this stock. So that's what I would want to do. So what we can do is, when you are If you bought Bharti, let's say at whatever price, 1100 rupees, 1500 rupees, the stock is trading at 1900, you would want to lock in your profits. Let's say if you bought it, let's say 700 rupee profit, right? So what you can do is on Bharti, you could create a trigger order, right? Which is a sell that, sell Bharti when it touches 1800. That means you bought it at 1100, the stock is gone to 1900. Obviously, you think it'll go to 2000, 2500. But what if it falls below something, goes bad globally? You're making a good 800 rupee profit. You want to cushion 700 rupee out of it. You can say that lock my 700 rupee of profit in this stock. So what you do is, you just place an order at 1800 rupees. If the stock continues to go up, you will continue to hold the stock. You can enjoy your full profits. If the market for some reason falls, and you want to ensure that you made some decent trading profits on this, you could, their trigger orders will get triggered. And this is for any stock, right? I mean, let's say Hindustan Aeronautics, from 4100 is gone to, let's say, 5000, now is kind of seeing a correction. You want to ensure that at least let's say 4700, you will at least lock in 700 rupee of profit. And this is typically happens in trading. I mean, when people are looking at 3 to 6 months, when the volatility happens, we feel that, oh, had I sold, it would have been much better off. So, so with the ICICI Direct platform, you could lock in your profits with the trigger order, which, as we said here, is here. You can use that for selling. You can use that for buying anything. You could use that. The other thing we just wanted to kind of showcase to you on ICICI Direct is, let's say, whenever you're selling a stock, let me take an example of Ashok Leland, right? Ashok Leland, if I were to sell Ashok Leland today, let's say I want to sell 100 shares, our systems will give you alert, an eye alert, saying that the company has given a bonus, and if you hold the stocks for next 4 days, you will be eligible for the bonus. Would you like to sell? So a lot of times what happens is there are dividends in the stock, there are corporate actions in the stock, and the benefit of the dividend or the corporate action would have just come had we hold the stock for next 3-4 days. So we build this capability on the web platform and on the mobile platform also, wherein if you are selling a stock and you are obviously not aware about which company has given, at what time have they given dividend, or what time have they given bonuses. Even if you are not aware, our systems will prompt, ICICI Direct systems will prompt you saying that, would you like to sell it at this point of time? So that's another feature that we built on the application whenever you are doing a transaction. The other thing which I'm sure many of you are familiar, but just for the interest of people, I want to still highlight is our eATM facility. So yesterday being a Friday, I mean, had you sold a stock on yesterday, traditionally what happens elsewhere in India, because India has a T+1 settlement, right? So if you were selling a stock today, or on a Friday, T+1, which is Friday is T, Saturday, Sunday is off. Monday evening, the brokers get the fund. And typically the brokers then, if you make a request, non-banking brokers typically take a day to kind of give the cash back. On ICICI Direct, if you were to sell a stock, you could select eATM and the cash would come to your account, savings account, within 5 minutes. So on a Friday at 12 o'clock or in the afternoon, were you selling ABB and you needed the funds? Obviously, that's one of the reasons why people sell. You could have got the cash in your account within 5 minutes at no extra cost. And this comes to around 1 crore rupees a day for many of our customers who are at the best variant of Prime plans. So this is all that you have to do is just select eATM here. There are no charges. You don't have to pay any extra money. But the only difference is that instead of your money coming to you on a Tuesday, here, if you sell tomorrow, which is on a Monday, the cash in the actual bank account will hit on Monday. So that's another thing that which, I mean, India, we are at T+1 settlement. We are talking about 5 minutes settlement on the ICICI 3-in-1 account, which is linked with your ICICI Bank savings account. So that's the other thing, which I wanted to kind of just showcase to you. The other thing also when you're buying stock, and one of the challenges or for investors is that a lot of times we're fully invested. So let's say, I mean, ABB, I mean, Pankaj spoke about as stock for the long term in the capital goods space, and is also a stock which we have recommended in our Gladiator. I mean, in the price patterns also, we believe it's a good price pattern at this point of time. Now, if you were to buy ABB, and obviously, if you want to buy, let's say, 10 shares of ABB also, you require certain amount of cash. And as investors, we're fully invested in the market. So what you could do on ICICI Direct platform is a very simple thing is, just click on pay later, right? So if you click on pay later, you don't have to pay the entire 57,000 rupees, as you can see here, of ABB at this point of time, or you want to buy 100 shares of ABB, you don't have to pay 5 lakh 72,000 rupees at this point of time. If you choose pay later, if you choose pay later here, you just have to pay around 30% of the margins. And this margins also you could use it using your shares. So you could pledge that and buy the stock completely cashless on ICICI Direct. So the only cost there is a cost, I must tell you, which will get incurred. You will have to pay interest on the, in this case, around 38,000 rupees, you'll have to pay interest. Our interest rates are at 9.69%, which would be amongst the lowest at this point of time. So, if you're looking at from an opportunity point of view of investing in a stock, you could use the pay later option or the MTF option, which is popularly called in the market on the ICICI Direct account. One thing I just want to kind of showcase to you also, and this for investors who are little portfolio investors, want to create a portfolio of few stocks. So let's say I want to create a portfolio of gold, right? I mean, I want to have some investments in gold as well, and I also want to have some investments in silver, right? I mean, that's also an asset which kind of is an asset which people believe that is will can do well. So let me let me just add a silver ETF here. So you can, or let me add an HDFC silver ETF here. Yeah. And I want to buy, so I want to make a portfolio, right? I mean, this portfolio is a combination of, gold. This combination is a portfolio combination of silver, is a portfolio of some great stocks like, let's say Pankaj spoke about Larsen and Toubro, right? And I want to have Larsen and Toubro also in my portfolio. And I also want to have, let's say, Apollo Hospitals also, I mean, in the portfolio. So what you can do on the ICICI Direct account is, you could create a basket of stocks. You could even say that this is my long-term holdings, and you can even say that this is something for retirement or for next 2-3 months, let's say chemical theme if you're playing, and then you could set up an SIP in that. So what you're doing is, you are creating a customized portfolio yourself. It could be a combination of Nifty 50, which are the top 50 companies in India. It could be a combination of certain stocks, which are, let's say, I mean, some Bharti or stocks that we see here, or I mean, commodity ETFs. I mean, these are all stocks that will ETFs or stocks which will come to your demat account, and you could set up an SIP every month and build and accumulate these portfolio. And then you could even see that on your platform. I mean, how this is an ETF basket that you see here, which was created, and how this basket has done well, done over a period of time. So you can really track all of that on the ICICI Direct platform. Another thing, I mean, I'll kind of rush through for a few of the critical things also, is the research recommendations, which you saw from Pankaj Test from ICICI Securities. The entire research is accessible to you on ICICI Direct platform, both mobile app, and you could get it, all this on your even WhatsApp as an app notification itself. So these research are given to ICICI Direct customers absolutely free of cost. Over the last 10 years, we've had I mean, a decent, I mean, I would say track record. Our track record is 82% for the last 10 years of all the recommendations that we given to our customers on Gladiator stocks. So, you could look at getting these recommendations so that if what would ICICI kind of recommend our customers to invest. And as I said, you could get this on your WhatsApp as well. So you could go here on the settings icon. You could go to manage manage subscriptions, and enable WhatsApp. And this is free of cost. It would go to you whenever we give a recommendation. There is a condition that we have. The condition is that if you're active in a month, once if you're trading actively investing on ICICI Direct, you'll continue to get it. If you don't, you're not actively investing on ICICI Direct, then you don't, then the WhatsApp notification stops. That's the only condition that I want to kind of talk to you about. I'll kind of move to a few more things because I was reading a lot of chat, and there were questions from traders also. And whenever people trade in the market, one of the most critical thing is to test whether the hypothesis that I have will play out or not. And I'm talking about from a trader's perspective. Let me just use a strategy. And I'm moving to now from investors, long-term investors to traders. Sorry, let me just cover one more thing on the investor part, because I just want to do this because a lot of investors also wanted to invest in gold, right? So if if any of us wants to invest in gold and set up an SIP in that, so it is you're setting up a monthly SIP of gold, on your account, and you could set it up. That means every month 10,000 rupees of gold, which is as an exchange traded fund, would come to your demat account, which means over the next 1 year you will invest around 1,20,000 rupees on gold at the price which is trading in the market. It trades in units, and and then whenever you want to sell it, so after 1 year, 2 years, 3 years, whenever you want to sell it, you could sell it as well. And the entire returns will be linked to gold prices. So I mean, how the gold prices will move over the period of time, that's how the entire returns that you would have on gold would completely link to. So I mean, if gold does well, I mean, the portfolio will do well for you. So I'm saying you can set up an SIP also in gold as a single stock in your account, gets credited to your demat, and you hold it for 5 years, 10 years, 6 months, as much as you want. So that's also there on ICICI Direct platform. It's getting very popular. Hence, I wanted to take this time and talk about gold as an investment opportunity on ICICI Direct. Coming to active traders, who are trading in the market, I just want to kind of showcase 3 things, and then we can open up for Q&A. So let's say people create strategies, right? And one of the very common strategies in the market is that typically the market is flat, right? I mean 5,700 points range. That's the range the market has during the day. And if you as the expiry comes near, the premium, as for people who are trading in the market would understand. I mean, if I were to just show you for people who are watching the screen, is an option chain, right? I mean, let me just show you an option chain. Nifty 21,500, 21,150 at this point of time. If you see the option chain of option prices at this level, the options, the calls of 25,500 call is trading at 41 rupees. Now, if Nifty does not go to 21,500, 25,500, this 41 rupees is going to become zero, right? Similarly, on the downside, a Nifty 24,800 put is trading at what, 25 rupees. Now, if Nifty, markets were to kind of recover again, this entire 25 rupees is going to become zero. Or if the market were to have a sharp fall, this 25 rupees can significantly become in the money, and you could create alpha there. So the point is that you may have different strategies, and the most important thing is can I backtest my strategy? So that's what we have created on the ICICI Direct account. So which is on a Monday morning, if I were to go and sell at the money options, both call and put, which means I'm not expecting the market to be let's say do a lot. I mean, I'm expecting the market to remain flattish on a Monday morning. Let's say if that is what I believe, and I could, let's say, or I want to do this on every expiry, which is every Thursday, of the month. I want to backtest this, or every Sensex expiry, I want to backtest my strategy. And the strategy could be anything. I mean, I'm selling out of the, options. You could buy options also if you think there is volatility. I mean, we could, the strategy is completely on you, and you could then go and backtest this strategy over, let's say last 3 months, last 1 year, last 5 years, as to had you deployed a strategy in the had you deployed a strategy, how would your returns have been? So let me just again go to the backtest. Apologies, for clicking on trade. Now, if I were to backtest this strategy, as you can see here, I am just doing it for last 3 months. As I said, I can do it for any period of time. And then I could click here and run a quick backtest. And our systems will go back last 6 months, last 1 year, and whether the strategy that you had in the market, that let's say market beyond a point will will give a breakout, you could backtest your strategies. And if you feel this is a strategy is working for you, I mean, as I said, short strategies, iron butterflies, these are common strategies where a lot of people deploy on expiry days. So if you were trading in the markets, you could backtest your strategy and then take that to live. So it takes around 45 seconds to a minute for the entire backtesting results to come. But that's also a capability that you have on the platform, wherein your results of of whatever that you want to deploy comes about. So I'm going to move in, but just to give you, it is there under Smart Tools, under backtesting as an option. This feature is available. Another thing, I mean, a lot of people, as we know, I mean, trade in the market and deploy a lot of strategies, right? And if I were to just give you, an option chain first showcase to you, let me just make this as full screen. You can click here and make this all as full screen. And you were believing that Nifty 25,100. I mean, it actually was at 25,500. It come down to quite a support. The global tariff news will kind of die down, and the markets will go up again, right? And you could kind of let's say, or buy options, and a lot of people sell options. And there's a seller of options who create certain who think that ki abhi market iske niche markets will not fall below this level, or markets will not go above this level, and then they sell options. Now the risk with selling a Nifty option is if markets were to move 200 points on Monday up, or I mean and it moves for 500 points, you really become deep in the money, and there is the losses kind of really creep in. Or even for option sellers, put sellers, if you sell put option, thinking the market will not go down, and if markets fall 500 points, you really create a sizable risk for yourself. So what people do is, they create, hedges on their portfolio. So iron condor is a very, very common strategy where, selling in the money call, you're selling in the money put, and you are buying a protection, which is a hedge, which is a long option. So if you see this payoff graph, your maximum risk is defined, which is going to be 780 rupees, and your maximum profit is going to be 390 rupees. So on this trade, that if the trade does not go in your favor, the maximum loss that you will have is 780 rupees, and you could create this as a strategy on the platform. And you can also see the margins. Also, if you see here, the margins have significantly reduced, right? From 4.5 lakh rupees to 96,000 rupees, the margins have come about. So that's another difference, and it is because of this long option. So if I were to delete this hedge, you see the margins, right? The margins is actually 2,69,000. It was because of the long options, the margins reduced because the risk of the trade portfolio was reducing. So that's something which you can see here. You can analyze your payoff. I mean, everything that you can do on ICICI Direct. What is the maximum risk that you have on this strategy on expiry day, and then you could deploy that strategy to live. So that's another thing that I want to kind of talk to you about. And on the ICICI Direct platform, you could go to Smart Tools and you can look at all that. The another thing which I want to talk to you about, and I'll take the next 2-3 minutes to just summarize everything, is for traders again who are trading in the market, and doing a lot of people who are doing trading, active trading in the market. let's say you were trading a Nifty 25,150 options, uh, and you were to say that that buy, you wanted to total of 300 quantity, and you wanted to say buy 75 shares every time the options goes down by 5 rupee, and sell every time it goes up by 5 rupee. So our systems will automate it for you, and then you don't have to worry. I mean, it goes on 5 rupee, it'll buy, it'll average down for you, and it goes up, it'll average, and it'll book your profits as well. So our systems today would have the capability to kind of set up, the orders that you would manually kind of then book about. Now, the last thing I just wanted to kind of talk to you about on ICICI Direct platform for people who are trading in the markets, one of the key elements is that we don't require 50% cash margins in F&O segments. As you can see here, there would be 0% cash, and the entire money would be allocated on securities. And we don't charge interest also to our customers who are under our prime plan. So that's also is an additional benefit. And the last thing I want to talk about is on the ICICI Direct account with the ICICI Bank Savings account. One of the fundamental differences that we offer to customers, one is the ease of moving money from the bank to the trading account. No UPI, no RTGS, no NEFT, no half an hour waiting, and the interest on the funds in the trading account. So as you can see here, I mean, whatever money that I have in my trading account right now, I'm earning interest of my savings bank account at this point of time. I'll be daily earning an interest. I mean, on a Saturday, Sunday, there is no way I can trade. I mean, and Friday, if you travel, Monday, if you don't trade, for 3-4 days itself, the interest would be 300-400 rupees, which our customers definitely, get it in their savings account and, get the interest benefit, at times even more than the brokerage that they pay. So I'm saying on the ICICI Direct platform, whether it is your funds, whether it is your securities, whether it is research, whether it is, giving you the right information, when you're buying or selling, or while you're buying or selling, all that's there. So we urge you to spend time on the platform, and please reach out to any of us. I mean, all our, the entire colleagues who have reached out to you today, entire relationship managers who are working with you, and we would love to kind of, showcase our platform more to you. So that's what I want to kind of, talk about. We could take a few questions now. Pankaj, yeah. So Pankaj, let me just take a question on Tata Motors. I think that's the question people have asked, and people have broadly also asked on EV. That where do you see EV as a space? Where are the value chain? I mean, which is typically when people talk about EVs, they only talk about 4-wheelers or 2-wheelers. Is the value chain of EV just in 2-wheeler, 4-wheeler, or is it in the battery segment, or is it in, let's say graphite? I mean, where is the value chain? And specifically, if you could take the question on Tata Motors.
So, Saurav, on Tata Motors, the challenge is in Tata Motors is the JLR portfolio. I think for a long period of time, sales in JLR is about 4 lakh. This year is expected to be lower because of the tariff-related challenges. So that is where I think the Tata Motors is struggling. On the domestic side, our sense is that the CV cycle should pick up because of the government spending, and also on the PV side, they've been doing okay, not really as great as M&M is doing, but valuation-wise, this stock is quite attractive. So I'm positive on Tata Motors. Now, on the value chain for EVs, like you sort of said, so one is the battery chemical as a space, what one can look at. There two companies come to my mind. With one is the Gujarat Fluorochemicals. I think they're investing one of the significant amounts in the battery chemicals. The other one is a small cap name like Neogen Chemicals. The kind of partnership, what they have done for electrolytes and electrolyte salt is quite good. One for electrolyte, they have tied up with Mitsubishi, which is a Japanese company, and then for electrolyte, there is again Morita is the name of the JV partner, and which is done well even in the with respect to Chinese competition as well. And yes, for anode, graphite players can be looked at. So HEG is already putting a capex of nearly 2,000 odd crores. While the core business could come up, because the overall sense is that when you sort of produce steel through the blast oxygen furnace route, you sort of emit a lot of carbon dioxide or other polluting substances. But when you sort of set up a EAF, which is what Tata Steel is looking to do in a country like UK, then you require a lot of these graphite electrodes. So yes, you have players like say HEG, you have players in the battery chemical like say Gujarat Fluorochemicals, and also Neogen Chemical, which I just spoke of. So these are the companies which look attractive to us from a portfolio perspective. There could be many more names, but these are the names which are coming to my mind. And again, from a OEM perspective, you could have players like, for example, again, bearing companies also, because see, in bearing companies in auto, the demand for EVs, when you sort of produce, the bearing requirement is a lot more higher. So from that perspective, and the bearing companies which I just highlighted, the likes of say Timken, SKF, I would add one more name, NRB bearings, to that list. So yes, it's a value chain which is going to sort of shape up very well going forward.
Thanks. So, thank you. Thank you. I am getting a lot of questions on NRIs. First of all, I must say that for NRIs, they obviously would love to put their money in India. From where they are, let's say in Middle East or UK or US, the kind of returns in India is, India as a country has given it's significant. But the kind of entire ease. So yes, the answer is that could you analyze invest on through the ICICI Direct platform and their ICICI Bank savings account? Absolutely yes, and that's something which really gives them ease. So what will happen is that either you will have an NRE account or an NRO account, and you could link either your either of these accounts. So you could use your repatriable funds, invest in India, and move the money absolutely seamless. So we'll open up your 3-in-1 account, which is your ICICI Bank, NRE account, your demat account, and your trading account. So your funds move into your trading account at a click, and then you could invest in India 24/7 wherever you are in the world. The entire PIS reporting which is required for NRI, which is a portfolio. Under the RBI, there is a portfolio investment scheme that's done by us. The entire TDS, which is required, which is tax deducted source, is also done by us. We adjust the TDS. So actually, it gives you a complete, seamless access to invest in India and put your money. So NRIs definitely could invest. You could reach out to our NRI branches. You could reach out to our NRI on digitally. You could reach out, and then we'll call you back and explain you how do you kind of get started on NRI. So on NRI, I think one I wanted to speak about. There's question, Pankaj, on 2 questions. One is Hindustan Aeronautics. I think I specifically saw this question a couple of times. Though defense stocks have moved up, this particular stock hasn't moved up. There are a lot of news in the market about Tejas getting delayed, Tejas coming. Where are on the business side? Where do you think HAL is? I saw your entire slide on defense as a theme, which you are very bullish on. Particularly on HAL, any particular view on this?
So yes, Saurav, I think within the defense pack, Hindustan Aeronautics is probably the only company which hasn't done well from a valuation perspective. Also, it's attractive. I think it's trading at about 35 times on a forward basis. The wish list of Air Force is to have 50 squadrons, and so which means that typically in a squadron you have about 18 to 20 odd planes. And currently we are at about 32 squadrons. And if you sort of notice, day back or 2 days back, we had a crash of Jaguar. I think Jaguar, we have about 90 to 100 aircraft. So all these aircraft need to be sort of replaced. So sum total, there is a requirement of 500 to 600 planes. Now, near-term challenge for HAL has been the case that they have not been getting the engines for Tejas Mark 1A. Hopefully, from August onwards, they'll start getting 2 engines, and then that is where the revenue recognition for HAL will also sort of come in. And while government is also talking of getting a new player, the opportunity size is quite large. Just to give you sort of very crude number, if the requirement is nearly 500 to 600 kind of a plane over the next 10, 15 years, a plane easily cost about 1,000 crore. So that number, you're literally looking at a top line of 5 to 6,000 crores. Current HL top line could be about 30,000 crores. So I think the best is yet to come for HL. That is what I would want to believe. Yes, you have challenges in terms of engines not coming on time. One has to probably live with it, because a lot of defense partners really not sort of support, or not able to support when needed. But I think HL looks quite attractive in the defense overall as a pack. The other one would be electronics. So gone are the days when defense used to be a mechanical equipment. You require a lot of electronics. At least the India-Pakistan limited war, what we have seen, used a lot of electronics. So Bharat Electronics is another one. It's closer to our target price, but that is another stock which I structurally like within the defense space.
Right. Right. So I think we'll kind of, just running in fact, overextended our time as well. So I would like to thank, Pankaj, and like to thank all of you for joining this session. Our objective of this session, to detail out the views on each sector was that, as investors, we build more conviction in the investment that we're holding. And that conviction takes us through the bad times, that when the stock prices don't do well, and that can happen, unfortunately, for extended period of times. We believe in the business and we hold on those investments, and then truly wealth creation in stock markets happen. That's why we want to spend time on research, and then since you're putting your hard-earned money, the kind of emotional connect people have towards the platform is also very, very high. People, in fact, spend hours, I would say, every time, you come, you log into the app, you see the portfolio, you see the stock price. So we want to showcase to you some of the good things that you could use on our platform, when you're using. So again, as I said, thank you so much, everyone, for joining. This video will be sent to you. The YouTube session will be sent to you as well. You could go through that. Our teams are there, happy to connect with you at all point of time for all your queries. So thank you once again for joining. Thank you, Pankaj. Thanks, everyone.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.